All right, let's dive right into this masterclass explainer. Today, we're stepping into the shoes of an expert investment analyst. Using all our source materials, we're going to perform a complete top-to-bottom stock analysis. We want to uncover the true intrinsic value of this company by applying the exact legendary methodologies used by Warren Buffett, Peter Lynch, Benjamin Graham, and modern Wall Street analysts. To solve the mystery of this stock, here's our agenda. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. DCF and multiple models. And finally, 6. Synthesis and verdict. Let's get started.
Section 1. Company Snapshot.
First things first, we have to establish exactly what we're analyzing today because, well, you really can't value a business if you don't understand how it makes its money. Select Medical, trading under the ticker SEM, is an absolutely massive player in the post-acute healthcare space. They operate all across the United States with 103 critical illness recovery hospitals, 41 inpatient rehabilitation hospitals, and over 1,900 outpatient clinics. In their latest quarter, they pulled in over $1.4 billion in revenue, growing at a steady clip of about 5%. So we're looking at a dominant top 3 market share leader in a highly fragmented industry. But here is the elephant in the room. The stock is currently trading at $16.60. Yet there is a pending take-private buyout offer from its founders, the Ortenzio family, along with the private equity firm Welsh Carson Anderson & Stowe. And that offer is for exactly $16.50 per share in cash. So wrap your head around that. The market is currently pricing this stock 10 cents above a firm buyout offer. Our job today is to figure out if there's some hidden value here that justifies a higher price, or if investors are just playing a really dangerous game of chicken.
Moving right along to Section 2, the Buffett lens.
So, does this company pass the ultimate quality test? You know, Warren Buffett looks for economic moats, consistent earnings, high returns on equity, and absolutely crucially, manageable debt and clean management. Looking at Select Medical's metrics, they definitely have that solid market share and highly consistent earnings. In fact, they're forecasting between $520 and $540 million in adjusted EBITDA for 2026. The return on equity is also pretty solid, generating nearly $64 million in net income on $2 billion in equity just in Q1 alone. However, that moat, it's vulnerable. Their pricing power is heavily dictated by Medicare reimbursement rates. But the massive screaming red flag for Buffett, the debt. They're sitting on over $1.8 billion in long-term debt, pushing their leverage ratio to 5.4x, which actually just triggered a downgrade to a B+ rating from S&P Global.
And honestly, this brilliantly illustrates a key point. Because their owner earnings are constantly being eaten up by capital expenditures to build new hospitals, plus those massive interest payments to service that heavy debt burden, Buffett would likely pass on this entirely. He wants cash flow machines with pricing power, right? Not highly leveraged healthcare operators that are dependent on government rates. From a strict Buffett perspective, there's just no adequate margin of safety here.
Section 3. The Lynch lens. Let's pivot now and view this through the growth-focused eyes of Peter Lynch. There's a totally fascinating conflict in the data here. Based on its 5% revenue growth, Select Medical is what Lynch would call a classic stalwart or slow grower. Now, Lynch relies heavily on the PEG ratio, which simply compares a company's price-to-earnings valuation against its actual growth rate. With a forward PE around 13 and growth at just 5%, the PEG is well over 2.0. That makes it pretty expensive in Lynch's book. Combine that with a weak balance sheet, and normally, that's a hard sell. But wait, the insider activity is massive. The founders literally want to buy the whole company and take it private. Lynch loved insider buying, and you really can't get more bullish than an executive buyout. Still, based purely on his strict metrics, the lack of hypergrowth, combined with that huge debt load, would likely keep him safely on the sidelines.
Section 4. The Graham lens. Now, what happens if we strip away all the narrative and just look at the raw Benjamin Graham value math? Graham didn't care about stories, he cared about hard assets and defensive checklists. And when we run Select Medical through his defensive checklist, it passes almost every single criteria. It has adequate size, boasting over $5 billion in annual revenue. It has earning stability. It pays a consistent quarterly dividend of 6.25 cents. It has a moderate PE ratio, and it trades below its book value with a price to book of 0.96. The only, and I mean only, criteria it fails is the strong financial condition. And again, that's due to that towering debt load.
But here's where it gets really fun. If we calculate Graham's intrinsic value using his classic formula, which is the square root of 22.5 times earnings per share times book value per share, we get a completely different picture. Using their 2026 estimated midpoint EPS of $1.27 and grabbing their Q1 book value per share of $17.28, we arrive at a Graham fair value of $22.22. This means the current $16.60 price offers a massive mathematical margin of safety. From a strict asset value standpoint, Benjamin Graham would see this as a heavily undervalued stock.
Section 5. DCF Valuation.
Let's bring in some modern Wall Street math and build a discounted cash flow or DCF model. This essentially tells us what the future cash the business generates is actually worth today. Let's see how this builds our intrinsic value from the ground up. Because the source data lacks complete multi-year projections, as analysts, we have to make some explicit, reasonable assumptions here. S&P Global projects their free cash flow will hit around $120 million by 2027 as their capital spending lowers. For our discount rate, or WACC, which is essentially the company's cost of money, we need to peg it cautiously between 8 and 10%. That's because their B+ credit rating and high leverage just make their cost of capital expensive. Finally, we'll assume a terminal growth rate of 2%, basically matching long-term healthcare inflation. Now, running a sensitivity analysis shows us exactly how vulnerable this valuation is to interest rates and risk. In our base case, using a 9% discount rate and 2% terminal growth, the fair value comes out to just $14.20 per share. If interest rates really bite and we have to use a 10% discount rate, the fair value plummets to exactly $12. It's only in the most optimistic scenario, an 8% discount rate with 2.5% perpetual growth, that it breaks above $19. So according to our DCF model, the current $16.60 price is noticeably overvalued.
Section 6. Other Valuation Models.
Before we synthesize everything, let's cross-check our findings against standard market multiples and analyst targets. We want to make sure we aren't missing the broader market context here. Interestingly, comparing Select Medical against its sector peers using an enterprise value to EBITDA multiple, which basically values the entire business against its core operational earnings, yields a slightly different story. According to the data, applying a fair multiple to their trailing EBITDA gives us a fair price of $17.68, suggesting a little bit of upside. However, Wall Street analysts tracked by our source are far more pessimistic, placing a consensus target of just $15.50. That's largely due to concerns over their critical illness recovery margins and, you guessed it, the constant drag of their debt.
Section 7. Synthesis and Final Recommendation.
Okay, let's bring all of these legendary frameworks together for our final analyst verdict. We've looked at the assets, the growth, the cash flow, and the multiples. And bringing all these metrics together reveals a pretty violent split. The Graham asset-based model and the EV/EBITDA model both think the stock is cheap, potentially worth anywhere from $17 to $22. But the DCF cash flow model, the Wall Street analysts, and importantly, the actual pending buyout offer from the founders themselves all suggest the company is fully priced or flat-out overvalued at its current $16.60 level. So, here is the crucial takeaway. Select Medical has a great market share, solid growth in its rehab segment, and trades below book value. But the risks? They're substantial. They carry a massive $1.8 billion debt load and face continuous vulnerabilities with Medicare reimbursements. Even more critically, the pending insider buyout completely changes the math on this whole thing. While the company might be mathematically undervalued on an asset basis under Graham's lens, that pending $16.50 buyout effectively captures upside. Therefore, our final verdict as an analyst today is a firm hold. There simply isn't enough margin of safety to justify buying above the deal price. Which leaves us with one final provocative question for you to consider before putting your own money on the line. At $16.60, with the founders already agreeing to take it private at $16.50, you're essentially paying a premium purely on the hope of a competing bid. Is that incredibly slim chance truly worth the massive downside risk if the deal collapses and the price drops back down to its DCF value of $14? That's the reality of arbitrage for you, and exactly why, right now, the sidelines are probably the safest place to be. Thanks for joining me in this explainer, and keep learning.